Welcome, everyone. The markets felt anything but stable this week. Oil is surging on renewed Middle East tensions, gold is back in the spotlight, and currencies are reacting sharply as traders shift their focus from data to geopolitics. This is All Access, where we dive into the market's biggest moves and help you make sense of what is driving them and what to watch next. I'm Yoli, Deriv's head of marketing, and with me as always is Prakash Bhudia, our head of trading and growth. So let's get into it. Welcome, Prakash.
Thank you, Yoli.
So oil has jumped sharply on renewed Middle East tensions, with Brent approaching $75 mark, that $75 mark, and some traders are even whispering about $120 in a worst case scenario. So what's the highest level we can expect?
Okay, so that's a very, very interesting topic. If we see, the moves post-tension, oil is behaving by the book. So the geopolitical headlines and tensions, we saw Brent and the wider energy structure spiking higher. So the intraday high it got as high as almost $79 for Brent crude, and settling lower at 74. And you see this morning it's under 71. So we're seeing, of course, the spillover in energy. We saw some pressure on equity, particularly transport sector, discretionary. So energy is really the only sector which was holding up, but it's kind of classic, big reaction and then repricing kind of move. So the initial move was probably pricing in much more disruption, when that didn't arise over the weekend, we saw the energy structure repricing slightly lower. So in terms of levels, as you mentioned, there's a lot of levels floating around. I think we need a much bigger escalation for oil to reach the resistance level of $80. For 90, again, we need a lot bigger. 120, I think, is very much the tail risk territory.
But some analysts are bringing up the possibility of a new long-term oil surge or a super cycle. That was largely dismissed until recently. What do you think is driving this narrative? Is it something traders should take seriously?
I'm skeptical, personally, and all you have to do is look at the futures, the futures pricing structure for oil. So, for example, the repricing that's happened has been mostly in the front end. So these are the contracts delivered in July all to October. So you see that the front end pricing structure steepening there. But when you start looking much further out, so futures around 11 months from now and further, you see that the futures curve flattens and even dips into mild contango. And that's the shape of the futures curve tells you that the market sees the current tension as transitory and not structural. So if it was a real super cycle, like the 2000s where we saw, China's industrial boom, we had a lot of factors, urbanization, infrastructure development, you'd see the whole futures curve shift up, with all of the futures pricing much higher. But instead we see that those long dated contracts have barely moved. So I don't think the market is yet buying into that sustained demand story yet. Even with this move, the real test isn't how far the price moves, particularly it's the persistence which matters. So if oil can keep holding higher as time goes by, then that will force a repricing of inflation expectations and may start spilling over to other transmission mechanisms, like affecting the rate cut timelines, having wider impact on forex and global flows. But at the moment, that's not happening. So we see.
Prakash, what it just occurred to me that some people might not know what the characteristics of a super cycle is. So how would you describe what a super cycle is?
A super cycle is a such that you have huge demand where it's not just the front end repricing, but it's basically the whole futures structure. So you're seeing sustained demand from all sectors, so it's impacting producers, capital markets, long-term hedges. So every sector's feeling this increase in structural demand. So to call something a super cycle, you'd need this broad-based capex. You'd need sustained demand from developed and emerging countries, so big demand from China, India, or you'd need some other big infrastructure wave that completely rewires the long-term consumption curve. That's what we're looking for.
Okay, and in your opinion, we're not there yet. With respect to oil. Okay, let's talk gold. So the prices came close to 3,450, again, amid these tensions and central bank buying. But with inflation cooling and rate cuts still not guaranteed, is gold rallying purely on fear, or is there something more structural that's going on?
That's a good question. Of course, following the tensions, we saw a spike in gold. It cleared 3,400. Since then, it's drifted lower with oil as well. So, in terms of the driving factors, I think it's a bit of both. However, even with this, the tension-related volatility, it's the structural bid which is standing out. So, the fear trade, tensions, etc. It's kind of intra-cycle, but the current move that we've been seeing is less about like a retail-driven rally like we saw in 2020, but we're seeing that balance sheet demand from sovereigns and large allocators who are treating gold like a digital cash. So I believe it's a bit of both, but I think that it's the structural bid which is standing out over time and will keep driving the gold price higher.
Okay, speaking of digital cash, so Bitcoin dipped after briefly recovering on the back of rate cut expectations, but persistent trade tensions and political uncertainty seem to be weighing on crypto markets. Why is Bitcoin struggling to hold gains? And what would it take for, the uptrend to resume?
You see that recorrelation following tensions, and you see Bitcoin behaving like a macro-sensitive risk asset again. And, we essentially see the price falling with stocks. What probably didn't also help was the political drama between Musk and Trump. We saw tokens like Doge and others which had that speculative flow behind them, dropping double digits. So we can see how fragile the sentiment still is in some of these the altcoins. But for the uptrend to resume, we probably need some more stability in geopolitical. We probably need the macro stability as well, and or a fresh catalyst like stronger flows by tech flows, or a new crypto approval ETF, or in Asia or in the Middle East. So we're looking for the next catalyst here. But of course, what we do see is Bitcoin has not been acting like digital gold right now. So gold has been holding, while Bitcoin, lost some of the key levels in this down move.
So the yen has staged a sharp rally recently, driven by the safe haven demand and potential BOJ policy shifts. With global risks mounting, is the yen reclaiming its historical role as the ultimate shelter currency?
I think yen is behaving like the old yen again. So for the last couple of years, dollar yen has traded like a rate differential proxy. So now with oil risk and geopolitical instability and rising JGB yields, the yen is acting more like a fear hedge again. So I think we can expect some more big moves in the yen, and it's all. What was also interesting is the dollar actually held firmly following the geopolitical tension. So the dollar actually is also seen in this instance was seen as a safe haven currency. So that was interesting as well. But I think the yen strength overall. It's not happening because there's intervention in the market. So, I think we are starting to see the old yen again. So we should see it move a lot more, acting like a fear hedge again.
After the ECB delivered a well-telegraphed rate cut, both the euro and the pound strengthened. Is this simply the result of a weaker dollar? Or are we seeing genuine signs of resilience in the European currencies?
Yeah, so I think the euro and GBP firming, post-cut, but not really aggressively. I think it was a measured repricing, and especially with Fed cuts maybe delayed but not denied. It's not unexpected to see this firming. I think we are seeing a bit of a subtle shift here, and we are starting to see the markets care more about growth, asymmetry, and the fiscal positioning as well as the policy rate differentials. So maybe we're seeing some more. Maybe we'll have a case for more interesting moves. We see possibly the euro decoupling from the kind of the ECB equals weak narrative. So if that holds, we could see more capital inflows into EU assets, especially if the US fiscal credibility erodes further. So
is that a good thing for forex traders? Like, does that mean more volatility? What should traders be looking for?
Yeah, so I think it does mean a lot more volatility. it means that there could be some more upside in Euro USD pairs like Euro USD, GBP USD. So yeah.
All right. Well, an interesting post came up on X last week. It highlights the fact that the US stock market is now nearly 50% larger than the bond market, a gap not seen since the 1970s. Can you demystify this for us? Is that a bad thing for stocks or for bonds? How should traders think about this?
Yeah, that's very, very interesting. I think the first thing to note that it's not just about the size, it's about the concentration as well. So we see mega cap tech now dominating market capitalization and passive flows. So, there's if those names start correcting, or you see essentially the prices falling, then there's going to be fewer safe alternatives. And bonds used to be that cushion, but now with yields still high and duration under-owned, rebalancing flows may lag, and that makes the market more prone to volatility clusters. So the other thing, of course, is long end. So if long end yields keep rising, then this gap is likely to keep widening. And so equities, when they become this dominant in portfolios, even a strong down move, like a 10%, 5%, 10% correction can start shaking, various models like risk parity models and pension flows and cross asset correlations. So at the moment, while with this gap, we seem to be in an equilibrium. But I think if we start seeing some sharp moves in the future, particularly in equities, then we'll start seeing bigger shifts.
Let's just simplify a little bit for folks who may not be as knowledgeable. So the stock market being 50% larger than the bond market, what is it that's happening that's causing that shift? Do they think that there's more opportunity to make more money on the stock side of things versus thinking about safe haven of bonds? How do you characterize what's happening?
It is interesting how the two markets have tracked each other quite closely. And you do see, so I think the gap was caused by a few things, right? Firstly, we see these massive equity gains, but also that the concentration of gains as well. And then we also see, on the other hand, that the bond issuance hasn't kept up with the pace of risk appetite. So I think the equity outperformance in the last couple of years, post-COVID, does make sense, given the liquidity and the tech multiples and the disinflation. But what's unusual is the scale. So valuations have expanded even as interest rates have gone up and the fiscal backdrop has worsened. So normally, you do see sticky valuations at high interest rates, and then when you look at the fiscal, the fiscal worsening, you do think that there should have been a bit more pressure in stocks. So it is possible that now we're starting to see some signs, essentially, that equities might be overvalued. And one of the signs could be this widening gap. And then, of course, when we have a lot of signs pointing in this direction, at some point, you do start to see the repricings and corrections. So I do think that we should carry on watching this and other signs. For now, of course, we're not seeing big moves, and the markets shrugged it off. But it is an interesting story to keep watching.
With tariff deadlines fast approaching, an ECB cut behind us, the key US payroll data, what are the major catalysts traders should be watching in the week ahead?
Yeah, so I think this week it's all about where the pressure leaks next. So, this macro volatility, the geopolitical tensions, it's already in the system, and now it's about how it channels through various mechanisms like the treasury auctions, FX rotations, commodities. So I'm not sure whether there's any kind of single catalyst. We have, of course, there's lots of things to watch out for. The first is, of course, the escalation in the geopolitical situation. But so the main thing here is, of course, is if this becomes wider, and the possibility of contagion. So this could have the impact on supply chains and force a more wider macro repricing, particularly in safe haven instruments like gold and crude, and we have yen and Swiss franc as well. We have, as you mentioned, we have the tariff countdown. So we have those deadlines in early July, and this is the sleeper risk. So tariffs on key Chinese and EU sectors, autos, batteries, tech, they're set to activate in early July. So if there's no diplomatic off-ramp, we can expect the positioning to shift. And I don't think the market is fully repricing in an escalation just yet. In terms of other events, we, of course, have the FOMC rate decision on Wednesday. Mm-hmm. And there's going to be a projection followed by the press conference as well. And the market is not pricing in a cut until much later on in the year. So any news or guidance which impacts this could see even the cut repriced further out of the curve, or it could reprice earlier. So I think given the moves that we've had, the Fed is still going to be on a let's wait and see mode. We've not yet had much contagion in equities and wider economic metrics. So I think there's going to be no potential for an early rate cut given what's happening. So it's likely going to be wait and see. If anything, the Fed could signal that the cuts should be priced further out. So that would be an interesting dynamic to watch out for. We also have the BOE interest rate decision on Thursday, and the consensus is no cut from the BOE, so a surprise there would be interesting. And those are the kind of the main events that traders should watch out for.
So one more question, Prakash. We've talked oil, forex, gold, kind of in reaction to these geopolitical tensions, and you mentioned supply chain stocks potentially. When you say supply chain, are you talking about shipping stocks? What categories can traders be watching for?
Exactly. So shipping, anything to do with goods which are shipped. So it could include discretionary, consumer. So the assumption is also anything to do with where oil is a variable within the supply chain as well.
In those cases, like in the case of shipping stocks or in the case of discretionary you had mentioned, what's the trade? Are we buying puts? Are we what are we doing? Are we thinking that the prices are going to go down or up?
Options is definitely, given the volatility, options plays are the best way. Rather than, if you want to trade high liquid, then of course can easily just take a view in the overall stock indices, because if there's a flare up in tensions, then it's likely, well, actually oil, the easy trade is just to take a view on what oil is going to do. Either we see a flare up in tensions and oil spikes higher again, or we see contagion and oil drifts lower. So the most straightforward trade is oil or gold or other safe haven assets. And of course, then if you want to be more micro, you can pick out particular companies which might have overpriced the tension. I don't actually have any of these companies on hand.
Okay, no worries, no worries. As you guys know, this is not financial advice. This is strictly for educational purposes. Well, Prakash, thank you so much for another insightful episode. We appreciate you who are watching. Please do not forget to subscribe, hit the notification button. And if you're watching us on your favorite podcast platforms, please do subscribe. We'll see you next week.
Thank you.